Robert Willemstad viewed himself as one of the good guys. Most men do, of course, but he had tried to be one. Forthright, a by-the-book kind of guy. He took pride in his handshake being valued in New York, and even more pride in his hard work at being the engineer to Sandy Weil's dreamer in the construction of Citigroup. At that banking and financial giant, his unit was most assuredly not the one where the Securities and Exchange Commission and Attorney General had had a field day. He generated profits, not subpoenas. In a town full of executives, Willemstad was a businessman, or at least he tried to comport himself like one. Executives were appointed, carried out orders, and were paid what they were paid. A businessman built an enterprise, something that would outlast cycles and trends and perhaps even the man who built it. An executive focused on his mandate and cared for little else. A businessman had to be concerned with the totality of the company. Willemstad had always sought to keep perspective, to think a few moves ahead and solve the problem. That he had tried to do it as a human being and not a glory hound was a point of pride. He thought of this as he sat in a lovely waiting room outside the president of the New York Federal Reserve's office in the middle of September 2008 for a chance to speak to Timothy Geithner. Willemstad, the chief executive of AIG, was there to inform the Fed president that all attempts to secure a solution in the private market were failing. Cash was running out, and when their debt was downgraded on Monday, they were going to have to come up with at least $50 billion, maybe more. No one was willing to buy key units of the company, and there were no loans possible. Recently stung by the public outrage over its role in setting up a $30 billion portfolio to take Bear Stearns' more troubled mortgage bonds off J.P. Morgan's books, Geithner had been very blunt in telling Willemstad that no Fed help was forthcoming. Willemstad hadn't really wanted any. He had tried every route they could think of, including trying to become one of the 18 banks and securities firms that buy and sell bonds directly with the Fed. He had hoped this would allow AIG to access some of the funding programs the Fed had set up for these primary dealers to keep the markets vibrant. He never heard back. Hell, he couldn't even get Geithner to focus on the $2.5 trillion in derivative exposure AIG had when he had brought it up to him earlier in the week. So now he was there to frame out for Geithner and his staff what had been unimaginable for all of his more than 40 years in the banking business. AIG was going to die. Hank Greenberg's company, the cornerstone of both the New York and American business communities, was going to die. Competitors and customers alike had once admired its verve and audacity, but now they just feared whatever crater it made when it died.